The biggest trap in trading is liquidity. Most traders do not truly understand it, and that is exactly why they keep losing. Welcome to the ComLucro channel. By the end of this video, you will understand how to identify where price is most likely to go and how to take smarter trades. I will explain everything, step by step, through the three main types of liquidity. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Let's start with sweep liquidity. To begin, you need to understand what liquidity really means. In simple terms, liquidity is just orders in the market. It is money moving through the system. Price moves because of these orders. When buying increases, price moves up. When selling increases, price moves down. Large price moves rarely happen in the middle of a range. Why is that? Because very few orders are located there. Instead, most orders sit above swing highs and below swing lows. Sellers place their stop losses above highs. Buyers place their stop losses below lows. When price reaches these areas, it runs into a large pool of orders. This frequently leads to sharp reversals in the market. In other words, liquidity is simply orders clustered around key highs and lows. Recognizing this allows you to see where price is most likely to react. Pay close attention here, because this is where most traders misunderstand liquidity. In reality, there are three simple ways to identify liquidity without overcomplicating your charts: equal highs and equal lows, trend liquidity, and range liquidity. But here's the reality. The easiest and most reliable liquidity to identify is equal highs and equal lows. If you are just beginning, this should be your main focus. This forms the foundation of smart liquidity trading. Always remember, markets move because of orders. Our task is straightforward. Identify where the majority of orders are located. When equal highs appear, that represents resistance. When equal lows appear, that represents support. Basic trading education then teaches traders to place stop losses above resistance and below support, which means liquidity naturally accumulates above equal highs and below equal lows. Breakout traders add even more fuel by placing buy stops above the highs and sell stops below the lows, building thick pools of liquidity. This is exactly where many beginners make a mistake. They try to sell directly at equal highs. However, the market often pushes higher first, sweeps that liquidity, and only afterward makes the real move. Many traders call this a stop-loss hunt, but in reality, it is simply the market searching for orders. Institutions, the participants who truly move the market, require large pools of liquidity to enter positions. They cannot enter anywhere they want. So what do? They patiently wait for price to sweep liquidity, and only then enter from the opposite side. Now, what should you observe whenever you analyze a chart? If we study this area, we can notice multiple rejections and bounces. Since price respected this level several times, most traders would mark it as a support level. However, this support did not appear randomly. When we zoom out and examine the broader market structure, price was clearly bullish and produced a break of structure, BOS. This tells us that the real origin of this support is the extreme demand zone. If you study pure market structure, the sequence becomes clear. After a break of structure, price usually pulls back, and once the pullback finishes, we often see another break of structure. This sequence forms the foundation of trending markets. Now, let us focus on liquidity near the extreme demand zone. In this area, multiple equal lows have formed. Whenever equal lows appear, liquidity builds there because many traders place their stop losses below those lows. So, what is the logical move? We place a buy limit directly at those equal lows. Our stop loss is placed slightly below the demand zone for protection. And for our target, we look at the equal highs above, where liquidity is also resting. Now observe what happens. Price sweeps the equal lows, triggers our buy limit, and then reverses sharply to collect the liquidity at the equal highs. This shows how market structure, supply and demand, and liquidity work together. And this is how experienced traders execute their trades. Now let us move to trendline liquidity. In this example, we have the British pound against the US dollar. Many traders would connect these two highs and draw a trend line. Their common idea is simple. When price pulls back and touches the trend line, they plan to enter a sell. Others take the opposite approach. They wait for price to break the trend line and then look to buy on the pullback. But here lies the problem. Both approaches often fail. The reason is very simple. They ignore proper market structure. When we step back and read the chart correctly, the market is clearly bearish. We can see two bearish breaks of structure. In a bearish market, the typical sequence is break of structure, pullback, impulse, continuation. This is the core idea behind smart money market structure concepts. That is why relying only on trend lines is not enough. Now, look closely. Price is clearly moving in a downtrend. We have a supply zone, an imbalance, and most importantly, trend line liquidity building above. After several touches, liquidity accumulates above that trend line. So what is price most likely to do? Price will pull back, sweep the trend line liquidity, tap the supply zone, and then continue downward to create another break of structure. That gives us a clear plan. We place a sell limit at the supply zone, set our stop loss above the zone, and target the previous swing low. As price unfolds, the setup plays out perfectly. The target is reached and a new lower low forms. This is how market structure, liquidity, and supply and demand work together. And this is the approach you should be trading with. But liquidity does not only appear around supply and demand zones, it also explains something that frustrates many traders. Now let us talk about stop hunting liquidity. Many traders see their stop losses taken out exactly like this, and like this. The frustrating part is that even when they follow the correct strategy and respect all the proper rules, the stop hunt still happens. Let us clarify this. When you get stopped out, banks are not targeting you. The market is simply moving toward liquidity, where orders are concentrated. Here is what most traders do. They sell near the highs and place their stop losses above the high. They buy near the lows and place their stops below the low. What does this create? A pool of buy orders above the highs, a pool of sell orders below the lows. As a result, price naturally moves toward these areas to collect orders. That sudden spike that took you out was not manipulation. It was simply the market doing its job. Stop hunts are not personal. They are just liquidity in motion. All right, take a close look at this chart. Price has been rejected and has bounced from this level multiple times. Because of that, many traders naturally draw this area as a support level. Retail traders observe these previous bounces and assume that if price pulls back again, it will bounce once more. Based on that belief, they enter buy positions at support and place their stop losses just below it. However, here's the critical mistake. Since this support level has already been tapped and rejected many times, it actually becomes weaker rather than stronger. It is no longer a fresh or unmitigated level, which means it should not be considered high probability support. Now let's look at the situation from a supply and demand perspective. Instead of focusing on the support line, we identify the candle that appears just before the strong impulse move and mark it as our demand zone. Why does this matter? Because that large bullish candle shows that a significant amount of buying entered the market in that area. Very likely institutional participation. There is another important detail to notice. We also have an imbalance in this region. An imbalance simply means that price moved so aggressively that some orders were left unfilled. When this happens, price often returns later to fill those orders. Since this demand zone is still unmitigated, there is a strong probability that price will pull back, fill the imbalance, tap the demand zone, and then continue moving upward. Now look below the support. Because of the repeated taps, equal lows liquidity has formed. Retail traders place their stop losses right below that level. This creates a large pool of liquidity beneath the support. So the plan becomes simple and mechanical. We place a buy limit at the demand zone. Our stop loss goes slightly below the zone, and the target is the swing high. As price moves downward, watch what happens. Retail traders get stopped out. Liquidity below support is swept. The imbalance gets filled and price taps directly into our demand zone, triggering our buy. Then, price moves higher and reaches our target. This single setup delivers roughly a 1 to 6 risk-to-reward trade. Whenever you analyze the market, the first step is to identify the trend in the market structure. Next, mark the supply and demand zones along with any imbalances. After that, you will clearly see where liquidity is sitting, and only then can you execute your trades with precision. But liquidity does not only appear around obvious highs and lows. Sometimes the market also creates traps for traders. Now let us talk about inducement liquidity. What is inducement, and how can it help you win more and lose less? Let us break it down. Before we move to live charts, you need to understand this concept clearly. Inducement occurs when the market draws traders to the wrong side in order to collect liquidity before the real move begins. Once you understand this, you avoid many unnecessary losses. You begin to identify higher probability trades. You stop reacting emotionally to price inducement, and you start trading smarter, not harder. What you are seeing on this chart is a clear example of how inducement appears in the market. Price is currently moving in a downtrend, and we have 2 supply zones marked. Most traders will immediately focus on the first supply zone and plan to sell when price reaches that area. At first glance, that seems logical because we expect sell orders to be waiting there. However, this is where many traders get trapped. Very often, that first zone acts as an inducement zone, an area that attracts early sellers before price moves higher into the real supply zone, and only then continues in the intended bearish direction. Many traders describe this as an unlucky loss, but in reality, there is clear logic behind it. Once you understand how it works, you can begin using it to your advantage over time. So how can we determine whether a zone is genuine or simply inducement? The answer mainly depends on 2 factors: liquidity and imbalance. In this example, imagine that an imbalance exists between the 2 supply zones. This means there is open price space that the market has not yet filled. If price had already returned to fill this imbalance, the first supply zone would likely act as a much stronger selling area. But because the imbalance is still open, the market often pushes higher to fill that space. This is exactly where inducement tends to form. Inducement becomes even clearer when liquidity is nearby. For instance, if equal highs form near this level, it suggests that stop losses are likely resting above it. And remember, liquidity simply represents clusters of stop-loss orders. So if most traders are selling from that first zone, price will often move higher first to sweep those stops, reach the real supply zone, and then begin the bearish move. These are the 2 main ways to identify inducement: an unfilled imbalance and nearby liquidity. In the next section, I will show you real chart examples so you can recognize this setup in live market conditions. Here we have a 15-minute chart example of inducement in action. As you can see, the market is forming consistent lower highs, and we have just seen a break of structure, confirming a new downtrend. Most traders will immediately look at this area and mark it as a supply zone to sell from when price returns. But here is the catch. This is a single movement, and there are also multiple imbalances within this move that may lead price toward the higher supply. Because of that, these lower zones actually act as inducement, not the true reaction point. To help you understand this better, I will zoom out on the chart again and explain it more clearly. Notice that movement number 1 is an impulsive move to the downside. Then we have movement number 2, which is a bullish retracement. After that, movement number 3 is another impulsive move to the downside with a break of structure. It is this last movement, number 3, whose retracement we are now analyzing. You should never try to buy in a downtrend or attempt to predict a reversal. That is one of the worst mistakes a trader can make. So, based on inducement logic, we do not expect a strong reaction from the zones below. Instead, the higher supply becomes the real area of interest. Why? Because although the lower supply attracts sellers, we also have equal high liquidity and unfilled imbalances pulling price upward. More importantly, when we look further to the left, there is no remaining imbalance above the higher supply, which strengthens it as the true selling point. Notice the clue. The lower supply zones have already been retested, but the higher supply has not. So how do we trade this? The clean approach is to enter from the true supply zone. Place the stop loss above the highs and target the lows, since the market is still in a downtrend. And as price played out, that is exactly what happened. You can also use a confirmation-based entry. Have you ever looked at the same chart with multiple inducement zones and felt stuck? Unsure which one you should trade? If you cannot decide which zone to choose, here is a simple trick. Drop your time frame from the 15-minute down to the 5-minute. On the 15-minute chart, you might see two separate supply zones. However, if the 5-minute structure still appears bullish, you need to be cautious. Notice how price completely ignores the first zone and breaks straight through it. That happens because the internal structure was still moving upward. The key is to wait for the structure to shift. We only look for a sell entry once price officially turns bearish. Watch as price begins to pull back. When price breaks the recent 5-minute swing low, we call this a change of character. This acts as confirmation that the trend has shifted from bullish to bearish. Because price shifted with strong bearish momentum, it left behind a fresh 5-minute supply zone. This is where we take action. Place a sell limit order directly at that 5-minute supply zone. To stay protected, set your stop loss just above the higher 15-minute supply zone. For your take profit, aim for the recent 15-minute swing low. Notice how cleanly price respects the new bearish structure. It taps our zone and then moves directly toward the target. If you found this helpful, let me know in the comments. I will be glad to answer your questions. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.